You've heard the phrase, right? Whenever the markets get a little crazy, someone somewhere is yelling, buy the dip. It sounds so simple, so confident, but what does it actually mean? And, more importantly, is it always a good idea? Well, let's get into it.
Okay, so just picture this. You open up your investing app, and bam, it's a sea of red. That one stock you really believe in is down. For a lot of people, that first gut reaction is pure panic, right? It's that feeling of, oh no, I gotta sell before this gets any worse.
But, there's this other group of investors, and for them, this moment isn't a crisis at all. It's an opportunity. They see that falling price, and instead of panicking, they're thinking about doing the exact opposite.
So what exactly is this strategy? Well, at its core, buying the dip is all about seeing a market downturn not as a reason to run, but as a potential golden opportunity.
Okay, so here's the textbook definition. You're buying an asset, could be a stock, crypto, whatever, after its price has already dropped. And you're doing it because you have this core belief that the drop is just temporary, that the price is going to bounce back and then some.
Honestly, the best way to think about it is like this. Imagine your favorite pair of sneakers, the ones you know are amazing quality, are suddenly on sale for 20% off. You wouldn't think the shoes are suddenly terrible, right? No, you'd see it as a bargain. That's the exact same mindset behind buying the dip.
In a perfect world, the playbook goes like this. Step 1, the price drops. That's your dip. Step 2, while everyone else is freaking out, you step in and buy more at that lower price. And step 3, the asset recovers, shoots past where it was before, and you've made a nice profit. Sounds pretty good, doesn't it?
All right, let's actually put some numbers on this. I want you to see just how powerful this can be when it goes exactly according to plan. So let's say we have a stock that's just cruising along, trading at a nice, stable $100 a share. Everything's looking good. Then, wham! Some bad news hits the market. People get nervous and the stock price dips down to $85. Now, while others are selling off, you see that sale sign and you decide to buy in. And sure enough, a few weeks go by, the market chills out, and that stock doesn't just recover, it shoots up to a brand new high of $110. So let's do the quick math here. You bought at 85 and it went to 110. That's not just making your money back, that's a nearly 29% gain on your investment. That right there, that's the dream. That's why this idea is so attractive to so many people.
But you gotta ask, what gives someone the guts to jump in when everyone else is running for the exit? It isn't just wishful thinking, it's a very specific kind of mindset.
So, people who do this successfully tend to have a few things in common. First, they've done their homework. They're confident the company or asset is fundamentally solid for the long haul. Second, they truly believe the price drop is just an emotional overreaction from the market. And finally, and this is a big one, they see all that shaky, volatile price action not as a risk, but as an opportunity.
Okay, so far, buying the dip sounds like a slam dunk. But, and this is a huge but, there is a dark side. What happens when that little dip isn't a dip at all? What happens when it's the start of a total freefall?
There's a phrase on Wall Street you really need to know. They say, never try to catch a falling knife. And yeah, it's a pretty intense image, and for a very good reason.
A falling knife is what happens when you buy what you thought was the bottom, only to watch in horror as the price just keeps on dropping and dropping. You reached out to grab a bargain, but instead, you just got cut.
And really, this slide gets to the absolute heart of the problem. How on earth do you tell the difference between a temporary dip and the start of a real long-term decline? On the left, that's what you want, just a little blip in an otherwise healthy uptrend. But on the right, that's the disaster. That dip was actually the first domino to fall in a major downward spiral.
So, let's just recap the biggest dangers here. You risk catching that falling knife, you might have totally misread the situation, and this isn't a dip, it's a permanent problem. And maybe most importantly, trying to perfectly time the absolute bottom, well, that's something even the pros almost never get right. It's basically impossible.
So, where does all this leave us? I mean, buy the dip is obviously a powerful idea, but it's also loaded with risk. The real trick is learning how to approach it smartly.
And that brings us to maybe the most important takeaway of all. Successful dip buying isn't just about being optimistic. It's a strategy that has to be built on a foundation of solid analysis and research. It takes discipline and a very clear understanding of an asset's real long-term value.
Ultimately, that's the skill you're trying to build.
You have to learn how to separate all that market noise, the panic, the hype, the fear, from a genuine opportunity. You've got to figure out if the crowd is just overreacting or if they're seeing a real problem that you're missing.
And that's really the question I want to leave you with, because the next time you see the market turn red, you'll be able to think past that initial panic. You can look at that falling price and ask yourself the most important question. Is the market offering me a discount? Or is it trying to give me a warning? Answering that one question can make all the difference.